Today, we are diving into a really fundamental tool in the financial world, audit sampling. It's kind of the secret process that lets us trust the numbers coming from the world's biggest companies. But how does it actually work? Well, let's get into it.
So think about this for a second. You've got a massive global company. We're talking millions, maybe even billions of transactions every single year. Sales, purchases, payroll, you name it. How on earth can a team of auditors check every single one to make sure the financial statements are correct? It just sounds impossible, right?
And here's the big secret. They don't. They can't. It would be physically and financially impossible to do. So, if they aren't checking everything, how can they sign off on the numbers with any kind of confidence? Well, that's where the magic of sampling comes in.
All right, so here's our game plan. We're going to start by really digging into that huge challenge auditors face. Then, we'll introduce the clever solution, audit sampling. After that, we'll break down the step-by-step blueprint of how it's done, look at the two main methods an auditor can choose from, and finally, we'll wrap it all up with why this whole thing is so important for all of us.
First up, let's really wrap our heads around this core problem, which is all about the challenge of scale. For a modern auditor, it's not like they're trying to find a needle in a haystack. No, it's more like trying to figure out if an entire ocean of data is salty.
The solution, when you think about it, is actually pretty simple and intuitive. Imagine you're making a giant pot of soup. To see if you seasoned it right, you're not going to drink the entire pot, are you? Of course not. You just taste a single, well-stirred spoonful. If that spoonful tastes good, you can be pretty darn sure the whole pot is good to go.
And that spoonful right there, that is the absolute essence of audit sampling. It's the smart, elegant solution to this enormous problem. It's the technique that lets an auditor confidently give their opinion on the entire financial pot just by tasting a small, really carefully chosen sample. So, let's get formal for just a second. The official definition says audit sampling is applying audit procedures to less than 100% of items to evaluate the entire group, or what they call the population. The main thing to get here is simple. You're using a small piece to draw a reliable conclusion about the whole thing.
And this right here, this is the official blueprint, straight out of the auditing standards. It shows how auditors gather their evidence. Now, you'll notice it splits into two main paths. For today, we're going to deconstruct that path on the left, the very structured process they call audit sampling.
So let's zoom in on that process. We're going to walk through this blueprint step by step. This will show you the methodical, almost scientific, approach an auditor takes to make sure their spoonful is absolutely the right one.
The whole thing flows through 6 really logical stages. You start with careful planning and design, then you move into the core work of picking the items and testing them, and it all wraps up with projecting those results to draw your final conclusion. Let's break them down.
Everything kicks off with design. This is all about strategy. An auditor first has to set a super clear objective. For instance, are they trying to see if sales actually happened, or are they checking if the sales were recorded for the right dollar amount? That one question totally shapes the entire test that follows.
Next up, the auditor has to figure out this sample size. And this goes right back to our soup. How many spoonfuls do we need? I mean, is 1 spoon enough? What if it's a gigantic pot of soup? Things like how risky they think the account is or how important it is to the big picture, that's what determines if they need 1 spoonful or maybe 3 or 4 from different spots, just to be sure. It's got to be big enough to be meaningful, but small enough to be practical.
Okay, step 3 is selection, and this is crucial. It's not about just grabbing the invoices sitting on top of the pile. The selection has to be totally unbiased. That means every single transaction in that population has to have an equal shot at being picked. This is usually done with computer programs that use random or systematic selection to make sure the sample is truly representative. No cherry picking allowed. And now for the action. This is where the auditor takes those items they selected, say 100 specific invoices, and actually does the audit work. They're checking for signatures, verifying the amounts, confirming the dates. This is the moment of truth. They're finally tasting the soup. Finally, we get to projecting and evaluating the results. So let's say the auditor finds that 2% of the invoices in their sample have an error. They don't just stop there. They project that 2% error rate across the entire population of thousands of invoices. Then, they have to decide if that total projected error is small enough to be acceptable or if it's a real problem. This is how that tiny spoonful tells them everything they need to know about the whole pot.
Now, remember that blueprint we looked at? It had that fork in the road? Well, that represents a really critical decision the auditor has to make. They have to choose between two fundamental approaches to sampling, statistical and non-statistical.
The main difference here really boils down to objectivity versus subjectivity. Statistical sampling is all about math. It's driven by probability theory, which makes the results quantifiable and mathematically defensible. Non-statistical sampling, on the other hand, relies on the auditor's professional judgment and their years of experience. Both are totally valid methods, but the one they choose really depends on the specific situation. So, after going through this whole process, we get to the most important question of all. Why does any of this matter? Well, it matters because this process is the absolute foundation of what we call financial assurance.
I mean, think about it. Without sampling, auditing a huge company would just be impossible. Full stop. It gives a logical, reasonable basis for an auditor to sign their name on that audit opinion. It also strikes that perfect balance between being thorough and the real-world constraints of time and money. And at the end of the day, this methodical process is what builds trust between a company and everyone who relies on it, investors, banks, and you and me.
And that brings us to one last, really important thought to leave you with. Our entire financial world runs on trust. But as we've just seen, that trust often doesn't come from checking every single number. It comes from the integrity of a small, carefully chosen sample. Which just goes to show you how unbelievably critical is it for auditors to get that one spoonful absolutely 100% right.